Good afternoon, ladies and gentlemen, and welcome to the Westminster Group investor presentation. To start with, if we could cover a couple of housekeeping items. Before we begin, we would like to submit the following poll, which you will see on your screens. Throughout this presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen, or if anyone has dialed in via westminster@walbrookpr.com. We will endeavour to answer all questions today. However, failing that, the company will review all questions submitted and publish responses where appropriate. These will be available via your Investor Meet Company dashboard. And finally, we'd just like to remind you that this presentation is being recorded. In a slight change of order, we're going to start out with current trading and prospects, because that will cover many of the topic areas that I know you will have questions on in terms of current status. So we're going to slightly reverse the order. So if you will withhold submitting your questions during the course of this presentation until certainly you've heard that, that would be helpful. I'd like to hand over to Chief Executive Peter Fowler and Chief Financial Officer Mark Hughes. Peter.
Thank you, Tom, and good afternoon, everybody. I hope everyone can see and hear us okay. For those who don't know who I am, I doubt that's many, if any, but I'm Peter Fowler. I'm the Chief Executive Officer, and I'm accompanied today by Mark Hughes, our CFO, who will run you through the numbers shortly. Just quick overview then. So as Tom said, we're going to do it in a slightly changed order. So we'll do a very brief overview. I don't think I need to spend much time on who we are as a company and what we do, as I think most of the attendees will be aware. The presentation is going to be on the platform anyway later. So if we do have some new interested holders coming in, then you can look further there. So as Tom said, on the trading and outlook, obviously 21 is important. We'll run over what happened last year, but more importantly, really, is what's happening now and what's going forward in the future. So as Tom said, we'll start with an update. I'll give you an update on our current trading. Mark will then run us over various parts of the 2021 activities, and then I'll wrap up with our strategies and some of the growth opportunities that we're anticipating this year. Right, so moving on then, very quickly, I won't spend much time, as I say, on who we are, but I think everybody knows that we're a security and managed services business, and our client base is predominantly governments and large corporates. I won't spend much time on our revenue streams, our multiple revenue streams, although I did notice that we'd had 2 or 3 questions in on our business model, and I think it's just worth spending a minute or two just going over the fact that we have these multiple revenue streams in various parts of the world. We operate as 2 divisions, technology and services. There's a range of multiple revenue streams in each of those, and the importance of this has been witnessed, frankly, during the pandemic, when parts of our business were quite badly hit. As you can imagine, our aviation side was quite heavily impacted, but other parts of our business, performed quite well. So our ports business and our special services and COVID testing and things of that nature. So having our multiple revenue streams as we do is actually quite an advantage to the business. Okay, so moving on then quickly to our current trading. As I say, this is really what I think everybody is interested in. So starting off with our West African airport operations, we're actually performing ahead of expectations, and we're back now to near pandemic revenue levels. March 22 actually was the highest March figure ever, so that was very encouraging. It looks like April has come in at about 1% off of pre-COVID numbers again. So very encouraging in terms of our airport operations in West Africa. Just to put that in context, in 21, we were at 60% of pre-COVID. So the importance of that is we're a very operationally geared business. So our overheads don't really change much from year to year, as Mark will sort of walk you through in a moment. But so that 40% that we lost in 21 would have all pretty well dropped to the bottom line as profit. So you can see what a gearing effect that has on our business. And had we been back to pre-COVID in 21, it would have made a dramatic difference to our numbers. As it is, we're very encouraged for 22. Our Ghana port operation is performing to expectations. It's performing well. As many of you will know, a fourth berth opened up in late 21, so we're expecting further growth from that operation. And this is an area of the business that was not particularly impacted by COVID. So that's encouraging. The DRC ratification process, I know this is a topic that many investors are very anxious to know more about, and I'll just try and spend a little bit of time to try and explain a little bit more about what's going on there. So everybody will know that we signed the 20-year airport security contract, 5 airports in DRC in June last year. And at the time we stated the contract was subject to a formal ratification process before any meaningful activities could commence. Now, the ratification process is an obligatory, fairly straightforward procedure that government bodies in the DRC have to go through, and the purpose of it is to prevent contracts from being placed secretly or fraudulently without proper due process. So government bodies, the airport authority in our case, simply has to present the contract documents and a rationale why they want to go ahead with the contract to the central procurement body, which then has to issue a no objection letter to allow the contract to proceed. It's a fairly simple process. And just to remind everyone, our contract was negotiated with all the relevant bodies, Airport Authority, Civil Aviation Authority, Ministry of Transport, even the Presidency, over many months. In fact, well over a year, we were working on the project. The signing ceremony involved numerous people, including the British ambassador to the DRC, who was also a signatory to the contract. And so it was negotiated and signed with complete transparency. So there can be no question about that. And after the signature was announced, and I think this is important also, it was announced by the government themselves in their local press. So the ratification process was expected to only take a couple of months. In fact, when the signing took place, we were told it would just be a few weeks. It is a fairly simple process. So frustratingly, the delay has been caused by nothing sinister. It's just the internal process within the airport authority themselves, just getting themselves organized to issue the request for the no objection letter that I talk about. Now, I've obviously got to be careful. I don't want to embarrass our client by discussing their internal processes openly. Suffice to say, whilst the authorities, ministries, civil aviation, presidency all support the programme, and frankly, the airport security is desperately needed. Everybody accepts that. The procurement processes and procedures can't be bypassed. The airport authority can't be just told to do it. If they did bypass the procedures, then frankly, our project would be at risk in the future. It would be possible to challenge it in the future. So frustratingly, we just have to sort of assist the airport authority to try and get their processes in order. I think it's important to point out that no one is suggesting that this project shouldn't go ahead. As I say, it's got the support of all the relevant authorities. The airport authority themselves, they're the ones who signed it, just have to issue this no objection letter to let it take its course. So, I just want to reassure people the project very much remains alive. For prudency, as we've said in our annual report, we've now moved our expectations for this to commence in Q4. It may well commence beforehand, but we're only forecasting now from Q4, and therefore we're not taking too much in terms of revenue into our current year estimations. And I would just I just would make the point that it is a 20-year contract. I know the delays are frustrating and all the rest of it, but actually, in the scheme of things, a bit of delay is not as important as the long-term health of the revenue stream that we'll be seeing coming in. Okay, so I hope that gives a bit of flavour to DRC. It is frustrating, but it will come in, and it will be a very healthy and profitable contract as it arrives. Okay, moving on to our West African port project. This is another long-term 10-year managed services contract we signed in 2021. I have to say the client and the government authorities there are extremely sensitive about the project. So we have to be very careful what we talk about, particularly also in terms of the country concerned, although I think most people know where it is. Just to give you a bit of flavour, this project's part of a 10-acre port inspection, testing and storage complex that's being developed at the port. It's going to involve container storage, bonded warehouses, weigh stations, all sorts of paraphernalia that you would expect to see at a port operation. Our role is simply to provide the container screening and the intensive search activities, etc. And our client and the authorities are dealing with all the construction and the logistics and the procurement of the land that was required for this, and all the various planning and so forth that's been going underway. So nothing's being held up by us. We've been waiting for some of the infrastructure to be put in place. But we believe everything's on track, and if it stays on track, then we expect operations to start in H2 this year. Further on then, so training and guarding business this year that's performing and recovering quite well. It's performing much better than we saw in COVID impacted 21. We are winning new business. You may have seen our training business, for instance, has recently secured a project to provide training at one of the UK's busiest airports, trying to rebuild their capacity. So you might well guess what airport that is. Our product and solution sales are showing signs of recovery and improvement. We've talked before about delayed projects coming back on into discussion and so forth. And actually, we're quite encouraged by some of the projects that are now coming back live. You know that we signed a $1.7 million airport security project right at the end of last year in December. That's one of the projects we had expected to secure early on in the year and complete in 21. As it is, it's now underway and we'll complete it in 22. You may have seen that we've just issued a notice on a 300k contract for Parliament in a West African country, and 2 or 3 weeks ago we had another 100k contract for a national bank in a similar country. So there's lots of these projects starting to come on. They're not all million plus contracts, I accept that, but actually they're important contracts, and they're starting to show that business is returning in these areas. I'm pleased to say that our Palace of Westminster project has been very successful. It's now completed and we're into the 5-year maintenance program, and we're already talking about extensions, extra works, and additional services. So that's very encouraging. Westminster Arabia, it seems to have taken forever to get the business certified and so forth in country. That's now all completed, and as I say in the annual report, we do expect KSA to provide a welcome contribution to our 22 and future revenues. We are already now starting to see some projects come through, so we're very encouraged and excited about the opportunities there. I mentioned the 1.7 airport security contract. It's underway, and we expect that to be completed in 22, as I say. So that was an overview on some of the current trading. I'll give you a flavour of some of the other stuff that we're expecting to deliver on this year at the end of the presentation. But just quickly moving into where we are in, or were in 2021. In terms of challenges, yeah, of course, the UK did impact us. The UK entered a third national lockdown in the beginning of the year. It created numerous challenges for us, as you can well imagine, particularly as an international business. Travel is an important part of our operations, so travel restrictions elsewhere in the world did cause issues. There was a hope and an expectation that this would start to ease in H2. That never materialized. In fact, we actually saw, the Omicron variant coming in and the world sort of closing down once again. So, all in all, it was a challenging year for us. Having said that, I think we actually navigated it pretty well. We maintained all our operations around the world. Not easy with all the travel restrictions going on. We did identify new opportunities, not least moving into COVID testing with our partnership with Certific. That was quite an innovative move forward that produced decent revenues for us. We secured important new business, Tower London being a classic example. And very importantly, we kept all our people safe and fully employed. We did use the furlough scheme, obviously, where appropriate. So in terms of highs and lows, so dealing with the highs, our services division saw a 17% increase on 2020. That's quite healthy. Remember, our airport operations were still only running at 60% over the year, so that's a pretty good result. Our African airport, as I mentioned, had 60% overall, but we were seeing a gradual comeback, and it reached around 89% at the end of the year. And you just heard me mention that actually in 22, we are now already at pre-COVID levels, so very encouraging there. Our Tema port, as I say, continued to make steady progress. We did secure those new managed services contract, the DRC and the West African port. These will benefit 22 and more importantly 23 and beyond. So that's building our step changes in revenues that we will be seeing from these projects. Training and guarding were recovering. We secured those new contracts, Tower London, the airport contract. These are all important, classic and very lucrative contracts moving forward. Despite all the challenges, we still supplied goods and services to 60 countries across 6 continents. That's a success in its own right. And of course, we're quite proud that we were awarded the Queen's Award for Enterprise. And we held an award ceremony, an open day at Westminster House, and some of our shareholders managed to attend. But very encouragingly, we had a lot of high commissioners and ambassadors from various countries attend the show as well. And as a direct result of that, there are a number of discussions. One in the Caribbean that's very advanced for port security operations that might well turn into a long-term managed services in that part of the world. So actually, all in all, that was a very worthwhile event. Our lows, of course, product and solution sales were disappointing. No question that we were impacted by travel restrictions and business confidence. It was a challenging environment. You can imagine trying to do business with lockdowns around the world created all sorts of challenges and additional costs for us, trying to move people around and keep them safe. And of course, the delay in the ratification of the DRC contract. I know that's a frustration for everyone. Believe me, it's more of a frustration for me than anyone. So, but as I said earlier on, I'm quite confident that we'll see the end of that this year. Okay, Mark, can I have over to you?
Certainly. Good afternoon, everyone. What I'd like to do is, first of all, just run through very quickly the financial highlights of this year. As Peter said, we've achieved revenues of 7.1 million, which was a good result given the impact of COVID-19 had on us. It was down from last year, but that was primarily in the areas you'll see of technology sales. We've had this recurring revenue growth to 5.4 million. Up from 4.5, and that's despite the airport revenues being only 60% of COVID levels over last year, and they are coming back this year. The gross margin improvement is very much a mix effect. Our services business is high margin business. Our technology business is good business, but it tends to be at a much lower margin. So the more services you get, the higher margin you get in proportion. And that's the prime reason why it's gone up to 46% from 40% last year. We are, as Peter said, operationally geared. So because revenue was down due to COVID, the loss after tax was up, I'm afraid, to 1.9 million. Although our total equity to net assets increased, and we had commenced the year debt-free and remain so, other than that which is imputed by this operating lease debt standard IFRS 16. And during the year, we also had a reduction in capital, which was approved and implemented, which gives us a much cleaned up balance sheet and an ability to pay dividends or buy back shares at some time in the future. So if we move on to have a look at how the revenue has actually developed over the years, and there you can see the blue section, which is the technology revenue, was the main cause of us being down on revenue. In 2020, remember we had 3 months of good revenues and certainly some stuff coming through from the previous year. We had fever detection sales, which actually helped us. But it seemed in 2021 that everybody that needed fever detection had actually got it. And everybody's confidence was down. So there was no major solution sales in 2021. We are expecting this to recover. And as Peter already alluded to, we've already had at least 2 through and probably a number of others just about to drop. The service revenue dipped in 2020 because our airport in West Africa was closed and training and guarding and that went down. Ghana revenues increased in that time as we built the port up, but now the West African airport is rebounding in 2021 to 60% of COVID and beyond that expected in 2022. So let's have a look at the results then. As I say, revenues down largely due to the drop in technology sales. Services recovering and growing despite the airport's only at 60% of pre-COVID. Gross margin improving. Overhead's fairly consistent, and I'm going to put another slide on that, so I'll talk about that a little bit further when we get to that. But we were cushioned in 2020 by the furlough and the reduction in travel. So the bounce back in 21 is not unexpected. And of course, we've got these steady overheads. The business is operationally geared. And beyond the revenue inflection point, which I work out to be around 12 million, profits will grow quickly as everything coming on the top line, all the gross margin drops pretty well straight to the bottom line. So moving on to look at the overheads. 2020 reduces due to COVID and cost savings. Obviously, we did something to cut our cloth there. However, in 2021, we are investing in business development, which is why that has gone up. The administration and PLC management reduced with the job retention support and similar savings. Now that's been lost slightly in 2021, so it goes up slightly. And if you look at the total before foreign exchange, which is, I think, is the important one here, you'll see that our at 5 million, we're actually lower than where we were pre-COVID in 2019. Because of the effect of foreign exchange, we are very, very slightly higher, but it's only very, very slightly. Looking then at the cash bridge, we've remained essentially debt-free in the period. The cash funded some of these losses and an increase in the working capital. And we have been actually putting money into the new projects like DRC to get them up ready to go. Finally, then, I think I've got some of the financial results, key performance indicators here. And there you can see in the first one, the passengers served comes back to 77 million from 51 in 20, showing the rebound in the West African airport. Ghana vehicle containers served has gone up slightly, but fairly steady. Training actually has gone down in 2021 because of the lockdown, because we were training at the start of 2020 and it's gone down. And that's the same with the guarding days delivered. 2021 was a lower because of all the lockdowns and that there. In the technology division, some of the that lack of confidence can be seen in our average inquiries per month having gone down. And if you don't get the inquiries, the orders go down with them. We're still supplying a huge number of countries around the world. And the most encouraging statistic on this was the number of return customers, which has gone up from around 70 to 242, saying we must be doing something right when we've got the customer there. Anyway, that's my bit for the moment, and I'll pass back to Peter to go on for growth.
Okay, so as we say, obviously the last couple of years have been, slightly challenged by COVID. We're not the only company saying that, of course, and it is what it is. I just remind everybody that in H1 2020 we were profitable, as Mark just alluded to. We had a cracking first quarter pre-COVID. COVID then started to hit our airport operations and some of our services. Despite that, we had a good H1. Obviously, then as lockdowns and travel restrictions impacted over the next year or two, it sort of knocked us off course. I think what we're looking at now is 2022 coming back on that growth trajectory. So we've reset a number of our key goals for 22, including continuing to expand our product portfolio and global reach. That's important. Our global reach is important. The more countries we have recurring revenue coming from, the more resilient we are to regional and global events. Expanding our product portfolio is also important, and it's interesting that we do now have almost a weekly, if not daily, contact from manufacturers around the world asking if we can act for them as a shop window, if you like, for promoting products. Interestingly, we are looking to increase our UK and first world countries business in those areas. That's not to detract from our business model of focusing on emerging markets and high growth markets around the world, that is still a sensible thing to do for the business. It's where the high margin, high growth business can come from. But one thing that world events has shown us actually is, having a solid UK and first world business as well would be quite powerful. And remember, we already have a number now of very blue chip UK clients: the Tower of London, the Palace of Westminster, Scottish Parliament, the UK Border Force, UK prisons. These are all clients now of Westminster, giving us a pretty good solid foundation. Of course, there's many other businesses that we do in the UK, but there's an opportunity coming along, which I think could open up a great many other opportunities within the UK for us, and that's protect duty. I'm not sure how much you know about protect duty, but it's new legislation that's coming along out of the back of Martin's Law. Now, Martin Het was a young lad who was killed in the Manchester bombings a few years ago, in the Manchester terrorist attack, and his mother, Fegan Murray, has been a stalwart who's been driving what was Martin's Law, which is now becoming protect duty in the UK. It's going to be legislation later this year. And we've been working very closely with the authorities and everybody involved in putting together what protect duty is going to be. And in essence, it's going to require all publicly accessible venues, that's sports stadiums, theatres, right down to cinemas and National Trust houses, anywhere where the public have access to, whether they pay or not, is going to have to be required by law to put in appropriate levels of security and trained operatives. So it's not just a case of somebody who stands on the door and looks in a bag and doesn't take much notice of it and lets you through. Those days are going to be gone. There's going to have to be adequate training, adequate technology putting in. Now, this opens up all sorts of opportunities for Westminster. As I say, we've been very active within this. In fact, we Westminster sponsored Fegan Murray's dissertation on protect duty, which was released on Friday. If you look at our website, you'll see there's an awful lot of information about this. It opens up opportunities for our training, for our equipment sales, and more importantly, for many of these venues, for long-term managed services, where we'll take a small slice of the ticket revenue and provide the services, the support services, the equipment, training and maintenance and everything else that's required around this. It's a huge opportunity. The government, the UK government, reckon this will affect around 650,000 businesses in the UK that are going to have to increase their security. Of course, we're not going to be the only company chasing that business, but we've got a very big head start on this. So, I'm quite excited about the possibilities there. We are targeting ourselves to secure at least one more long-term managed services contract this year. I'm quite confident we'll do that. In fact, we might well see more than one. And as I was saying, each time we get one of these managed services, we see step changes in growth, 2, 3, 4 million at a time over 10 or 20 years. I would emphasize the issues that we've suffered with DRC and the ratification process is unusual. It's not normal. We've not seen it before. And I don't anticipate that's going to be an issue for any of the ones we're looking at going forward. We're targeting delivering another year of significant recurring revenue growth. If you looked at Mark's numbers or go back after the presentation and look at it, you'll see that our recurring revenue, actually, which is a foundation of the business, is growing quite strongly. So recurring revenue in any business, of course, is an important aspect. And I think we're now starting to build a real solid base of long-term recurring revenue. We do expect to move back to profitability. I was mentioning about H1, 2020. I think we're going to see that trajectory back again this year. Mark mentioned our inflection point. We get past that sort of 12 million revenue mark, and we start to see profitability growing quite quickly in the business. And we expect to deliver a sustained and material improvement in our share price. I know that's something that's close to all our investors' hearts. I get enough emails on it, so I know how important it is to everybody. Believe me, it's important to us as well. And I think that's going to come. We expect that to come as we start to deliver on our targets and opportunities this year. Okay, moving on. How are we going to do that? So in terms of some of the growth opportunities we're targeting this year, and I know this is, we put these numbers into our annual report, and I know that there's some confusion over this and our brokers' targets in the market. Can I first of all say the brokers' targets are the brokers' targets. If we achieve the brokers' targets, that means we'll have doubled last year's revenues and produced a very healthy profit for the year. That's no bad result whatsoever. I'd be very happy if we've done that. However, internally, the company are targeting the growth opportunities that will exceed the brokers' forecast. So, if that happens, then we would like to see and expect to see, obviously, upgrades on the forecast. That would be another good thing. Now, I'm not saying that these are all in the bag and done and dusted, but I can just explain why I think these are quite achievable. So, beginning with 7.1 million, which was our 21 revenues, they were COVID impacted. They were quite severely down, as you've seen, particularly in our product and solution sales. So, we're targeting doing an increase of between 2.5 and 3.5 million on our product sales. Now, given that some of our products are in the hundreds of thousands on their own, we don't need many of them to make that increase. With the confidence coming back into the market, the number of inquiries, quite sizable inquiries we're seeing coming in, some of the opportunities we're already working on, we do think that's an achievable number from a fairly low starting point, remember. As Mark was saying, the GPs vary, so on product sales we would typically see a margin of around 20 to 25%. New solution sales, we had negligible solution sales in 21. We're targeting around 3.5, 4.5 million increase in solution sales. This is where we bring various products together to create a harbour detection, a border security, or whatever solution. Most of the time, these projects are in the $2 to $3, $4 million mark. We've always done one or two of these a year for year on, year out. We didn't really do any, obviously, in the last couple of years. So do we think that's achievable? Absolutely, we think that's achievable. We only need one or two of the projects bubbling around to come in. And remember, we've already got the $1.7 million project that we secured in December already in the bag and already being worked on. So, we're part of the way there already. And then our existing services, we're expecting to do an increase of 3.5 to 4.5. This is all our services, our managed services, training, guarding, and so forth. Do we think that's achievable? Well, absolutely we do. Remember, our airport operations was 40% down last year. That 40%, we're already now at pre-COVID. We may even see the year out above pre-COVID levels, be our highest year ever. That's quite possible. So there's a chunk that's already coming back. We expect to see a growth in Ghana. We expect to see a growth in our training and our guarding and so forth. So absolutely. And remember also our DRC project, which, as I mentioned earlier on, we fully expect that to come on stream at some point in this year. We're only targeting Q4 ourselves. It may come in earlier. That starts to produce revenues. The West African port project starts to produce revenues. So I can see that actually, these levels are achievable. And if we achieve them, then we'll have an absolutely fantastic year. Okay, so that really sort of wraps up the presentational side of the presentation.
Yeah, super. Okay.
Yeah, thank you. Questions, I think.
Thank you, Peter. Yeah, thank you, Mark. Yeah, we do indeed. So if we could just turn to the questions. Obviously, we had many questions submitted in advance, a number of which actually have been addressed by the presentation itself, and we will group a few together as well. But I just wonder, particularly on DRC, maybe we can just come back and visit that because it is such an important topic. I'm going to just combine a couple of items which have been raised, which maybe you can just add a little colour to. So the first question, obviously, was why was it taking so long? And I think you have touched on that, but if you could add anything further to that, that would be great. The second element, Stephen asks, the 20-year term, is that from the date of signing or from ratification? I don't know if you can maybe add just a little colour on that too. And Farouk suggests that at the previous AGM, you suggested that bad debt wasn't a problem as people were expected to pay up front. Is that still the case? And especially with the imminent DRC contract, from personal experience, it's always been extremely difficult to recover debt from there. So I wonder if you could just touch on maybe a couple of those items just to add a bit of colour to DRC.
Okay, sure. Just to recap on the DRC, I know it's frustrating everybody, it's frustrating me, but it is a fairly straightforward process that we just need the airport authority to sort their internal processes out. It will happen. What more can I say? I think I covered that, earlier on. In terms of the 20-year, I can answer that absolutely. The 20 years will start when we commence operations. So normally on these projects, there is a 2 to 3 month period anyway from signing a contract to commencing operations. In this case, that 2 to 3 months is now stretched to about a year. But the 20-year period all starts when we start operations.
Can I pick up the bad debt point there? What you've got to remember is our model. Our model is that we're not supplying things to the DRC. We're supplying to airlines that fly to the DRC. So our debtor might be Air France, or we could collect through the IATA payment system. So we're not subject to DRC debt. It's worldwide airline debt that we are. And that's proving very good in our other West African operation. They're all paying up very well. And we have the ultimate sanction that if you don't pay us, we can stop you flying there.
Yeah. Okay. Super. Good answer. So another one, which is for you, Mark, I think. What trend are you seeing in 2022 related to the revenue split between sale of products, systems, training versus revenue from placing men on the ground?
Well, we're currently anticipating the revenue split will be around 60% to services, 40% to technology. So services is putting men on the ground, technology is selling equipment. Although that is almost a how long is a piece of string question, because any large technology contract could change that percentage dramatically, as could extra managed services contracts beyond what we're expecting at the moment.
Yeah. Okay. One for you, Peter. Do the board of directors think that it is now time to change the Westminster model to an alternative one that will generate more positive results, stroke better shareholder value?
Yeah, I know there was 2 or 3 questions coming in around the model. And I think that's really referring more back to, I think, the frustration over DRC than actually the model. I think the model is actually excellent, to be honest. I think having multiple revenue streams from multiple sources around the world is the right model to deliver sustainable and growth, particularly with long-term recurring revenue and a certain degree of resilience. COVID notwithstanding, we still managed to grow parts of our business. So I think the model is right. I think targeting large-scale, long-term recurring revenue contracts with governments and large organizations particularly in emerging markets. Whilst it's time consuming and can be extremely frustrating, the long-term nature of these businesses, contracts, as you secure them and the high margins that we can achieve from them, which we wouldn't see in other parts of the world, is a real recipe for growth. Notwithstanding the last 2 years, but you will see from the existing managed services contracts, they're very lucrative. So I think actually the model is the right model, and it's one that will prove itself as 22 unfolds and we enter the rest 23 and beyond.
Great, super, excellent. Your brokers are forecasting revenue of 14.3 million and a profit of 1.1 million for 2022. However, in your annual report, you refer to higher numbers. Can you explain that? I know you touched on that before.
Yeah, it's the point I was making earlier on. We don't issue forecast the market. That's what brokers do. The brokers have put forward a forecast that represents doubling of our 21 revenues and frankly a healthy profit. If we achieve that, then that's no bad result for anybody, quite frankly. If we manage to beat it with our target numbers, they're not our forecast numbers, they're what we're targeting the business on. Of course, we all know that timing and everything else is an issue in the markets we operate in. But if we start to achieve our targets, then obviously you'd see upgrades on the market forecast, which would be a positive anyway.
Yeah, great. Okay. One question, and this is also reflected by Daniel online during the presentation itself. Does Westminster need to raise funds? If so, will this be via a discounted placement? Probably one for you, Mark.
Okay, well, let's start with saying that we've just released our 2021 annual report, which contains a going concern statement signed off by the auditors. Now, anybody that's been through that process will know that the auditors want to be assured that we have sufficient cash already to get us through the foreseeable future, and that means sort of 12, 18 months, 2 years out. We had a net cash position at the year end of 0.9 million. Our brokers are forecasting this to rise to 1.6 by the year end. We do look at funding options for working capital, and particularly with these large potential contracts, and a COVID recovery loan is amongst these options. We're not ruling in or ruling out any option at this stage.
Great. Okay. Peter, is Westminster trading profitably at this current time?
Okay. So I think it's fair to say our brokers are forecasting we're going to make a profit this year for the full year 22, and we're comfortable with that forecast. And as I said earlier on, I just draw everybody's attention back to pre-COVID Q1 2020. We'd reached that inflection point already, and we were profitable in H1 2020. So I think now the worst of the pandemic is behind us. Hopefully, we believe we're back on that growth trajectory.
Great. Okay. What is the status of the West African port project announced in 2021? I know you touched on that already.
Yeah, I mean, as I said earlier on, as I said in the annual report, there's various things that had to take place, like logistics, licensing, procurement of land, planning phase, and all the rest of it that's been going on, not by us, but by the client and the authorities. That's pretty well nearing completion, as I understand. We think we're on track, and if we stay on track, then we'll be operational at some stage in H2 2020.
Great. Okay. Saudi, why has there been no tech purchase in Saudi yet?
Not quite true, actually. Yes, it's taken forever to get Westminster Arabia formed. I'm not blaming COVID, but it was due to COVID. Saudi was locked down. Their embassy in the UK was locked down. We had to get notarized documents back and forth. It took forever. It's done now. Westminster Arabia is up and running. We've already started to see some business starting to flow, and we do think that's going to be, a very welcome contribution to our business going forward.
Okay. Mark, we've got a couple of questions on cash. Maybe you can touch on what's the current cash position and has any of the overdraft facility been used?
Well, as I'm going to repeat myself a little bit here. We've just released the 21 annual reports with the going concern signed off, which does show that we have sufficient cash for the next 12 months. Now, obviously, large contracts will require additional funding. And for that, we've got various options. Our banking facilities are used from time to time for project bonds and guarantees and are available for short-term working capital if required. And we are looking at all the options, including a COVID recovery loan to cover that. And we remain cash positive.
Yeah, great. Okay. Peter, one for you, I think. Do we still have boots on the ground in DRC? And if so, what are they doing?
Okay, well, frankly, we've completed much of the preliminary work that we would normally do when we signed a contract. Remember, I said earlier on, when we sign these contracts, there's normally a 2 to 3 month pre-implementation period where we have to put boots on the ground and do a lot of infrastructure and logistics and everything else before we start a contract. Well, we've done all of that work. The boots on the ground for the most part now have gone. We do have presence periodically there, obviously, to keep on top of the ratification process. But I think the question's referring to teams out there. They're no longer there. They're dispersed elsewhere.
Yeah, fine, great. Okay. What progress, if any, has been made with the potential Central African Republic contract?
Yeah, well, our investors will know that in the normal course of business, we don't talk about contracts until they've been signed. There was an exception in this case following press speculation that there was a potential contract being negotiated in the Central African Republic. We had to put out a market note on this, just referencing it. And what we said at the time is the company confirms that it is in discussions relating to a managed services contract, although there's no certainty as to whether these will result in a contract or the timing thereof. That's a quote from what we said then. That remains the case. We remain in negotiations. Do I think it's coming in tomorrow or next week? No. Is it one that's in our pipeline? Yes, it is. But, no certainty of timing or outcome, as the saying goes.
Yeah. Okay. Final couple of questions, if we could. What has happened to the several sizable contracts referred to in the November trading statement that were expected to slip into 22?
Yeah, I think I might have touched on this already anyway. But there's absolutely right. During 21, we did see that lack of confidence. We saw projects right shifting, and we saw it from 20 into 21 and continuing into 22. As I said earlier on, we are now seeing a return of confidence. We start to see several of these projects starting to move again. The 1.7 million airport security contract for Southeast Africa is a classic example. That shift all the way from early 21 came in just before Christmas, and it's now going to benefit 22. There are a number of others that we've got in the pipeline. A 300,000 contract for the West African Parliament. Okay, it's not millions. It's still a very healthy contract and a great reference point to have. So a number of these are beginning to materialise, and we absolutely expect to see others this year.
Yeah. Okay. All right. Well, final question I think might be helpful. Could you possibly comment on the Iran JCPOA situation?
Yes. Okay. That's a point probably I missed in one of the slides. So clearly, we are continuing to monitor the US-Iranian negotiations over JCPOA. And if there's anybody that doesn't understand the relevance of that, just before President Trump unilaterally pulled out of JCPOA, we had actually signed a contract for Iran, for Tehran International Airport. It was a substantial contract. We had to then park it until such times as the sanction situation changed. We got very close a few weeks ago to the new JCPOA being signed. If anybody follows this, they'll know that. We're very close to the UK government and the Foreign Office and our embassy in Iran, who all, I have to say, are immensely supportive of our project on this. Who knows? If what happened a few weeks ago is they were about to sign it, and Russia then threw in a curveball saying they wanted a carve out from the agreement. So there was politics coming into play there, as you can imagine. So that's caused another delay. Who knows? But if this project, if sanctions get lifted, and they still may well yet, if they get lifted in the right way and banking sanctions come off and everything else, then we're in a very good position to revive that contract. It just needs an exchange of letters between the two parties. So we stay close to everybody that we need to on this, and watch this space, I suppose, is the saying there.
Yeah. Okay, super. All right. Well, look, thank you, Peter. Thank you, Mark. Quick comment to Michael. We've just had half a dozen questions in from you. We don't have time to address those now, but we will address those and respond via the published Q&A. Could I ask investors not to close this session? You'll now automatically be redirected for the opportunity to provide feedback. If anyone has any further questions or would like additional information on Westminster, please do get in contact via westminster@walbrookpr.com. Many thanks for attending today's presentation. We will update you again soon.